Welcome to the MB+M budget update. We're going to go through the much highly anticipated budget reform that was gone through last night. So we'd like to go through that today. With me is Melinda and myself, Miles. We'll look to go through at some of the key points that we think are relevant to individuals and your businesses. So first of all, Melinda, what was the main change out of the capital gains tax which seemed to grab everyone's attention?
Yeah, so the capital gains tax had quite an overhaul. It's to take effect the 1st of July 2027. Effectively, assets bought and sold before 30th of June 2027 continues with the 50% discount being available. After that point, it may be an indexation type of method, and then, it could be a combination of the two. The 50% discount remains for new home builds, and aged pensioners are exempt from, there's a minimum 30% tax on the CGT, and there's also no change to main residence exemption, super and small business concessions.
So those changes are obviously going to impact quite a few people that hold assets in property, shares, and there is a number of changes there that have to be considered in relation to that. The other change that has come about in relation to capital gains tax, which also affects a lot of individuals and especially property owners, is the reforming of negative gearing. This is effective on the 12th of May 2026 and will have a number of impact in relation to the treatment of negative geared investments and how they're treated going forward. Again, there will be a grandfathering provision for existing negative gearing properties or assets. However, going forward, there will be some changes to this. Along with these two changes, if that wasn't enough, we've also changed the way discretionary trusts are going to be taxed. So Melinda, would you like to go through that change?
Yes, so from the 1st of July 2028, discretionary trusts have a minimum tax rate of 30%. What this means to you might be that this type of structure isn't a tax benefit anymore. You need to be aware that this is to take place in the future as you may consider restructuring. Please note that primary producers are excluded from this, and there is some rollover relief for the transition of small businesses.
So again, this is something that will need to be looked at in the lead up to the changes in 1st of July 2028, and certainly will impact a wide range of people in relation to how they own their assets in a trust. Some of the other changes have been flagged more at the personal tax rates or marginal rates.
The tax-free threshold, the first tax bracket, it's reduced from 16% to 15%. That has a bit of a flow on throughout the tax brackets of a little bit of a tax savings there. And also additional to this, the government announced a $1,000 deduction that is allowable in individual tax returns. That requires no substantiation, so that's a bit of a benefit there.
And with those changes, the only change has been to the lower tax rates. All other thresholds and tax rates have been maintained the same for personal marginal rates from that side of things. In relation to companies and businesses, one change that has been, Melinda, is regarding the 20,000 instant asset write-off.
Yes, so currently it's legislated to end 30th of June this year. The budget announced that is to continue indefinitely for small business. So you can immediately deduct $20,000 worth of an asset and write that off.
In relation to retirees and the superannuation, so superannuation basically come away unscathed with no changes to the current capital gains tax treatment within superannuation. Also, recent changes to indexation for concessional and non-concessional rates have already been passed and go through, and also the recent Division 296 $3 million balance tax has already been passed and no change to those scenarios. So super pretty much got away pretty unscathed. Probably the other part, just more from a business point of view, is payday super coming to effect on the 1st of July 2026. In relation to Centrelink or Social Security, really no changes there in relation to age pension eligibility and rates. However, there has been a number of funding towards aged care and trying to increase the amount of aged care beds available, but also improving the access to home care for elderly residents in Australia. So they won't individually impact too much for individuals from obviously the recent reform gone through on the 1st of November in the aged care. However, overall, the federal government is looking to increase the availability of home care and also aged care bedding. In relation to those changes, are there any others that you can think of, Melinda, that are relevant?
There was company credits that for companies that might have a profit in 1 year might be able to claw back some credits if they had losses in the prior 2 years. This was something that happened a few years ago, so they've announced to bring that back in again, but that will be a couple of years off.
Fantastic. So like all of these budgets, nothing has been legislated yet, so it still isn't necessarily common law and put in place. And another thing is that if you think any of these are relevant to yourself, is to talk to your advisor about these and whether they are impacting your current situation and future tax structures or tax position. Thanks again for watching, and I hope to see you soon with our next update.
Thank you.